What is going on in the markets right now? When should I be concerned? When should I not be concerned? Listen, everything comes down to the fundamentals. And today we're going to be talking about those fundamentals, the things that you need to be paying most attention to. So stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well. Plan to retire well.
Hi, welcome to our show. Listen, today we're going to be talking about the market. Most particularly, we want to talk about the fundamentals of the market. Now, I know there's a lot of bad news out there. People are getting nervous, but what you want to pay attention to is market fundamentals. As a general rule, we want to look at anything that affects corporate earnings in any way, because earnings are going to drive the market ultimately. So whether that be good or bad. So follow along with me. I'm going to give you a lot of information, but I'm going to try to walk you through each and every one of them. So with that, let's start with us. We have been now 10 years, 6 months into this bull run. Now, a definition of a bull run is when you haven't had 2 quarters of negative GDP growth in a row. And we haven't had that since March of '09. Now, recent memory of 2000 through 2002 and 2008, where the market dropped to half its value, this is concerning to people because when it's been so good for so long, surely the shoe's going to drop, right? If you look at the major indexes, you can see the S&P 500 has been up 18%. You've got the Dow up 15%, the NASDAQ up 17% year to date. Coming off a year where those were negative in 2018, this is good news. This is just a chart of the S&P 500 the last 2 years. Look how volatile it's been. You know, we come off 17, you had 18 was down, and then you see, you know, the market dropped 20% in the fourth quarter of 2018, only to come back and some in this year. But with things so volatile, it's making people very, very nervous. This is just the S&P 500 compared to the world. VEU is basically all the world indexes except ours. So if you follow this backward, you'll find that for the most part, our markets will follow with the world market. So anytime you see that kind of diverge, you want to be starting to pay attention. As you can see over the last 1 year, it's really just we're pretty much tracking together. GDP growth. You can see the last couple years, you know, it was starting to increase in 2018, and all of a sudden in 19, we're starting to see a slowdown. Now, again, we're not, you know, we're not in negative territory, but you can see it's starting to slow down. This is something that we're going to want to pay attention to. The first estimate came out by the Feds for the third quarter is 1.8%. That's a far cry from what we had all last year. So let's be paying attention here. This is just a growth of stocks versus GDP. If you go back to 2009, you see that lower line growing slowly, basically grew about 24% in the last 10 years. But look at the stock market, the line above that. It's gone up 169%. There's a big divergence there between what our markets are doing and what the real GDP growth has been. This is just corporate debt as a percentage of GDP. You can see when it's peaked, it's generally followed by a recession. Right now, it's kind of peaked, crossed the line, higher than it's been in quite some time. So this is going to be concerning. Is this a leading indicator telling us something's coming ahead? Don't know, but we're going to want to pay attention. Unemployment, lowest it's been in 50 years. If there's one fundamental that's been, for the most part, driving this economy, it's been low unemployment and consumer confidence. But low unemployment, lowest it's been in 50 years. Well, why is that good? Because if more people have more money in their pockets, if they're working, then that's good for corporate earnings, going to be good for the market overall, right? So this is something we're going to watch, but I want you to see how it's been declining now since the recession, but all of a sudden it's flattening out. Look at the last year. starting to flatten out. Now, where we've seen unemployment be this low, usually the market has been at a peak high. And when there's been an uptick in unemployment, there's usually been a downtick in the S&P 500. So we're going to want to pay attention, because as soon as we start to see an uptick in unemployment, we're going to be wanting to see how the other fundamentals are doing, see if the market's going to maybe take a dip itself. A lot of people say, well, how can we trust the unemployment rate when maybe people are just getting out of the unemployment lines, right? Well, this is the civilian labor force participation rate. You can see that it has actually been on the uptick. So that's been a good thing. That means more people are jumping back into the workforce. Good for the economy. Now, I want you to stay tuned, because we're going to continue to talk about these fundamentals, so stay tuned.
Are you retired or approaching retirement in the next 5 to 10 years? Join the Centennial Wealth Advisory team for an exciting presentation with complimentary gourmet dinner and learn essential financial strategies for a comfortable retirement. 3 dates and locations to choose from. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Call 888-608-5825.
Hi, now welcome back. If you're just joining us, you're watching Retiring Well, and we're talking about market fundamentals, most particularly what we saw happen in the third quarter. Now, what you're seeing here is new one-family houses sold in the U.S. You can see that for the most part, it's been on the rise since the last recession. But look at it recently, the last year. See how it's kind of flattening out a little bit. A little bit of a concern. This is just median sales prices of houses sold in the U.S. You can see that it also has been on the rise, but of course over the last year has been kind of flattening out. So is this telling us that the housing market is starting to slow down? Don't know. With the Fed starting to lower rates and interest rates getting more attractive, will this be an uptick in housing? Well, it was last month, but we want to see that continue to be a trend. If this is a continued trend to flatten out or getting lower, then we're going to want to be paying attention. This is just the inflation rate. You can see it's, if you look at it with the Feds, they have a dual mandate. They want to keep unemployment to be very low, but they want to keep inflation in check. Most particularly, they like to keep it around 2%. Now, these are opposing forces to each other, because typically when you've had really low unemployment, you'll see inflation spike. That hasn't happened this time around, and it's actually caused the Feds to scratch their heads, because they keep expecting higher inflation, and that's why they were raising the rates to try to get ahead of it, but it never happened. So this is something we're going to want to pay attention to, but right now unemployment is low. The inflation rate's right where it needs to be. For all practical purposes, the Feds have it exactly where they want it. So what did they do back in July? On July 31st, they took the rates from 2.5 to 2.25. Very interesting. And then again in September, they lowered it another quarter point. So just last quarter, we went from 2.5% to 2%. Now, the Feds are calling this an action to try to keep the economy rolling. They started seeing things starting to slow down, so they're trying to get ahead of it by now lowering rates. I thought this chart would be interesting to see. Since the last recession, they lowered rates down to a quarter point. They left them there for the longest time, and then starting about 3 years ago, they wanted to start increasing them, as you can see. They got it up to about 2.5% in December of 2018, and the market reacted very violently. Again, in the fourth quarter, lost 20%. Now you can see they're starting to lower rates. They're starting to head the other direction. So is that good for borrowing? Is that people who are getting mortgages good? Is it good for corporations? Sure it is. But when the feds are starting to lower rates, that's typically a sign that they see things coming, not necessarily in a good way. So we're going to want to pay attention to this. This is the global pool of negative yielding debt. Listen, you know that old saying, there's nothing new under the sun? I think it's found in Ecclesiastes in our Bibles, but this is new. We've never had this, never had a situation where bonds were yielding negative interest rates. Now think about that. You're paying the bank for them to hold your money. And right now, you've got about 25% of the world debt in negative yield territory. Now, what does that mean? That means you're buying a bond that's guaranteed to give you a loss. Don't know where this is going, but you got almost $15 trillion of negative interest rates out there in the world. We've never been here before. Not sure what this means, but I dare say I hope we don't start to see our interest rates heading in the same direction. You look at the U.S. bond market. 33% of the U.S. bond market is investment grade. The rest of it is below investment grade. If you do anything, you're going to want to have an analysis of your own portfolio. If you're holding bonds for safety and you've got a significant amount in your portfolio in bonds, then this is something you're going to want to test for. How much of it is investment grade? Because if this bond bubble was to burst, and bond funds were to go bad, it's most likely going to be because of credit quality. And if they're below investment grade, those are the ones that are probably going to get hurt the worst. So if that's you, if you're somebody that just wants to have an analysis of your portfolio to see how you're structured, most particularly want to see how your bond quality is, then certainly give us a call.
We look forward to helping you plan to retire well.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors, specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Wednesday, October 23rd at Big Buck Brewery in Gaylord. Tuesday, October 29th at Lakeside Charlie's in Cadillac. Or Wednesday, October 30th at Boone's Long Lake Inn in Traverse City. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. educated financial decisions. Call 888-608-5825 today.
Welcome back. Now, if you just joined us, you're watching the Retiring Well TV show, and we're talking about market fundamentals, most particularly what happened in the third quarter. Now, what you're looking at here is U.S. wages and salary growth. This is important because if you see wages growing, that means more people have more money in their pockets. That's good for corporations. That's good for the market in general. Now, what's been interesting in all this is that with such low unemployment, as I talked about in the last session, typically you would see wages on the rise. And then when wages would be on the rise, you'd have increased demand, lower supply, which would increase inflation. But what we haven't seen that. We've seen an uptick in wages, but you haven't seen that grow like you would typically see with such low unemployment. So this is interesting. Now, last quarter I talked about this. What is driving this to keep it kind of flat is most companies are not necessarily raising wages. They're increasing their technology. They're increasing the ability to do things that they need to do that they used to have people do. So they're not putting it into wages, they're putting it into technology. So we're going to want to pay attention. Commodities, this is a CRB Commodity Index is just a basket of commodities tracking, I think, 18 commodities. And you can see for the most part since 2016 it's been pretty flat. Kind of been waiting for a breakout in that, but been flat. Crude oil, you can see that over the last 1 year it's went from $70 a barrel down to $50 a barrel. Certainly good for us, for those that have to put gas in our tanks, but not good for gas and oil companies. U.S. dollar. Now, this is the index that's been tracking this since 1973. They're looking at our dollar compared to all the other world currencies. All right, and back in 1973, they baselined it at 100, and then we've been tracking it ever since. Right now, at the end of the third quarter, sitting at 99. What's that saying? Saying that our currency compared to the rest of the world's currencies is the same as it was basically right now as it was back in 1973. Now, a strong dollar, you would think that's good, but the stronger our dollar is, the more costly it makes our exports. So that kind of hurts our manufacturing. You know, a lot of foreign governments, they try to manipulate the currency to try to get it down to make their exports cheaper. So we want a strong dollar, but we want it to be fair with the rest of the world so we can trade appropriately. U.S. consumer sentiment. Listen, this has been good. It's been good for quite some time. And you want consumers to feel good because if they're feeling good about the economy, they want to spend money. And when they want to spend money, that's good for earnings. That's good for the market as a whole. All right? But you can see as of recent, it's been flattening out. You know, people are starting to get concerned. And so, you know, they hear the news, they hear talk of recession, and sometimes this can be kind of a self-fulfilling prophecy because if they hear recession enough and they think it's coming, that'll cause them to hold back on some maybe major purchases that they would have maybe done. So we want to be careful with this, but it's been good for quite some time, but now starting to wane. If anything, this chart shows why it's so important. If you look between consumers and small business spending, it makes up a good 87% of our GDP. We keep hearing talk about China trade war and how it hurts our manufacturing, and that's very important. If manufacturing is down, that's something we want to be concerned about, but it's such a small part of our GDP. It's mostly consumer spending, small business spending. So if confidence starts to wane there, we're going to start to see GDP start to slack accordingly. I thought this is an interesting chart. If you look, this is the percentage of people that think stocks are going to be favorable or not favorable, and you can see that when it's crossed this line, when it's been more unfavorable, that's usually preceded a recession not very long after. So again, consumer confidence and how they're feeling about the economy is a big deal. And with all this negative news out there, I'm hoping that this is not going to continue to erode that confidence. And this chart, as you're looking at right now, is indicative of that. Anytime we've had a peak in basically consumer confidence, when it started to take a downtick, you can see that there's been a recession that's just followed it just after. Folks, the reason we want you to understand these fundamentals is because if you have a good, healthy understanding of what's going on in the economy and what to pay attention to, then you're not going to react so unfavorably when you see negative news out there. So if you're somebody that really wants to know how you're positioned in your portfolio, how much risk you're taking, then give us a call. No obligation, no charge. We'll be glad to kind of give you an analysis, see how you're sitting, see how much risk you're taking, and especially in the times we find ourselves in right now, maybe make changes if necessary. So give us a call.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors, specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Wednesday, October 23rd at Big Buck Brewery in Gaylord. Tuesday, October 29th at Lakeside Charlie's in Cadillac. Or Wednesday, October 30th at Boone's Long Lake Inn in Traverse City. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
Hi, welcome back. If you're just joining us, you're watching the Retiring Wealth TV show, and we're talking about market fundamentals. Now listen, this is what you're looking at right here. This is U.S. Manufacturing Index. You can see that when it drops down below 50, it's in contraction mode. Above 50, it's in expansion. Well, you can see of recent, it's been dropping, touching very close to contraction mode. Now, a lot of that has to do with China trade war fears, you know, the rising dollar, but we're going to want to pay attention because if this drops below 50, usually that's an early sign of things slowing down all the way around. This is U.S. non-manufacturing index. You can see that it's up above expansion mode, but very flat of recent, so it's starting to slow down as well. And this is just some of the world's manufacturing indexes. Japan, Germany, look at them on the decline. Now, if you looked at the earlier segment when I showed you how our index pretty much follows the world, if the world's indexes start to slow down, and many of them are now in recession, how long is it going to be before that kind of hits our shores? We are much more globally connected than we realize. So when it starts slowing down all over the world, when this kind of starts happening with a lot of the other world major manufacturing indexes, how's that going to affect ours? This is just the S&P 500 PE ratio. I told you earlier, earnings are so important because the market as a general rule trades at a multiple of its earnings. Historically, it's traded about 16, 17 times earnings. Now you look at this the last 5 years, it was starting to go on the decline, getting more close to our average, but of recent, starting to go back up again. So now if you look at forward earnings, they tell us that the S&P 500 is trading at about 16 and a half times earnings. So it's not necessarily in bubble territory, but it's certainly at the top as far as valuations go. U.S. corporate profits have obviously been on the rise of recent years. You look at this last 10 years, on the rise. But here's what's a little disconcerting. The forecast of the profits is now starting to slow down. It's starting to flatten out. So if we're looking at the S&P 500 and we're kind of at the top of the valuation area and it doesn't have a lot more earnings that can be expected, what is it going to be that's going to drive this up? We're going to want to be paying attention. This is just the VIX rate. This is what they call the Volatility Index. This is just a complicated algorithm that basically tries to predict what the market's going to do in the next 30 days, whether up or down. So a VIX rate of 20 says that the market's going to either be 20% up or it's going to be 20% of the down. Basically, it's kind of telling you how wide the highway is going to be. All right. Right now, it's at the end of the third quarter, it's about where it's always been at, kind of at its 30-year average, which is about 20. So we don't want to see that be too low, but we don't want to see it be too high. It's kind of where it needs to be right now, so that's a good thing. Yield curve. If you've been hearing anything in the news, it's been this, the inverted yield curve. Anytime there's been an inversion of the yield curve, it's been an early indicator of a recession coming. Now, not that we're in recession, but one usually coming maybe a year and a half out. Well, right now, the 30-year compared to the 5-year, the difference between the two is almost a half a percentage point. So we don't have any inversion there. If you look at the 10-year versus the 2, pretty close to inversion. They're almost the same. But I want you to see this chart because this is a little more indicative of what's kind of going on. If you look at the 3-month versus the 30-year, now what you should see when you look at this chart, should the 3-month interest rate be right here and the 30 be here and all of them in between kind of going up in a straight line. What you have here is you got the 3 short-term rates actually higher than the 1-year rate. And then from there it starts to go up. And if you look at the 3-month versus the 30-year rate, you got the 3-month rate almost at the 30-year rate. Folks, this is not a good thing, because and we're going to want to be paying attention. Now, we just had an inversion. This usually has to be this way for quite some time before it's a real concern, but it's something you're hearing a lot about in the news. It's something we're going to want to be paying attention to. Now, folks, I hope that you got a lot out of this show. Again, now this is kind of an abbreviated version of what we do for our clients every quarter. We usually have a live event. We talk about much more than this with them. If that's something you'd be interested in, you'd want to maybe attend or hear more of, or see how your position in your portfolio, then I ask you, give us a call. We'd be glad to give you no obligation, no cost analysis of your portfolio. So give us a call. Thank you for joining us.